Welcome to my YouTube channel, and this is the full course. And I think this is the first part that we're going to discuss. And I'm going to show you on how we can trade using what we call smart money concept. Okay, so full masterclass course on this subject. So this is the only video that you can watch. And I believe at the end of this video, you're going to discover a lot of secrets in trading. So make sure you subscribe to this YouTube channel. So first of all, we have to know about what we call the market structures. And when you're talking about market structures, you're talking about expansion and retracement. Okay, so this is the base parts I'm starting with. So we have to understand what is the meaning of expansion and what is what we call the retracement. Okay. Remember, before you talk about expansion and retracement, you have to know on what we call a trend. So we have three types of trends here. We have uptrend, we have downtrend, and you have what we call consolidation. That is sideways trend. Okay. So expansion occurs when there is an impulse movement towards a certain direction, and retracement is the collection movement after an impulsive movement. Let me show you. This is an example of the uptrend. When you look at the left side, you can see an example of what we call an uptrend. You can see we are creating higher highs and we are creating higher lows. So you can see here the structures are what we call highs and lows. So when highs are becoming higher and higher, that is where we create higher highs, and that is uptrend. But also when lows here, you can see are becoming higher and higher, that means we are creating higher lows, and that is what we call uptrend. But also you have to know we have these two kind of movement here. We have the first movement, that is upward movement, and we have what is called a correction, and we have another impulsive movement here, and we have another correction. As you can see, this upward movement in the uptrend is what we call expansion, and a correction in the uptrend is what we call retracement. So the market is retracing. So when you have an uptrend, that means the market is going upward. Any movement that is going against the uptrend is what we call correction or retracement. In downtrend, that is where we have also highs and lows, because those are the structures. Highs and lows can be obtained in the uptrend and downtrend. Okay, because the market is going down, that means the highs are becoming lower and lower, therefore creating lower highs, but also the lows are becoming lower and lower. That means we are creating lower lows. Okay, so E stands for expansion and R stands for retracement. So this is the basic part. You can see in this chart here, we had our downtrend here. You can see we had our expansion, expansion because it is downtrend, retracement, expansion, retracement, expansion, retracement, expansion, retracement, expansion. But here you can see we had what we call a reversal of the trend, and therefore expansion changed, and you can see we had expansion upward. Why? Because it is already confirmed that the market is uptrend. As you can see, retracement, expansion, retracement, expansion, retracement, expansion. So before we dive deeper, we have to know what we call Fibonacci retracement. This is the special tool that you can use to know if this is the end of retracement, so that you can determine the entry point. Okay, so Fibonacci retracement is used to determine the end of the retraction movement or retracement. Usually this price retracts to 50% or until what we call OTE, optimal entry point. Okay, so these OTEs are 0.62, 0.7, 0.5, 0.79. Okay, so this is these are the OTEs. These are the points which we call them Fibonacci retracement gold zones. Okay, these are very important points. Let me show you. For example, if you have our downtrend here, the market is moving downward, and we want to know the end of retracement, we can use what we call a Fibonacci retracement tool. So this is the tool that you can find it in your MetaTrader 4 or MetaTrader 5, and you can just use it for more confirmation, especially on the retracement. When you're drawing your supply and demand, your order blocks, you can use this tool to confirm if the entry point is correct. As you can see here, we have this gold zone here, these three lines, 0.5, 0.62, 0.705, and 0.79. You can see here we had our, you can see here, let me show you. Those guys who have seen my last videos, you know how we draw these order blocks. You can just watch that video, but I will show you in this masterclass because this is the free course that you cannot find it anywhere. Okay. So you can see we had this expansion, market moving down, and you can see the market was going upward. Sometimes, for example, you can be looking for the supply or demand here. So, and when you're looking at that, sometimes you have an order block, but you're not sure if you have to enter at that point. So what you have to do is to use what we call the Fibonacci retracement tool. Okay, so make sure you stay here. I'm going to show you everything. So for example, if you have an entry, for example, here, if you could have maybe, let me just give you an example. You could have maybe here, what we call you could have, let me take this tool here and draw for you. Let me take this tool here and draw for you. For example, here, this is just imagination. We are just, for example, if you could have maybe an order block here, that means after confirming that the entry is exactly at what we call the optimal entry, and the this OTE entry of 0.62, that means you could just enter here and take your trade. Why? Because there is alignment between those levels, golden levels of Fibonacci retracement tool and an order block. Okay, so this is how you can try to make sure you track the movement, you track the end of retracement, so that you can understand, you can identify if the market is reversing or not. Okay, so this is one of the very, very important tip you can use to get entries. Okay, so before we dive deeper, because we are still looking at the market structure, so I have taught you about the trend, and I have told you we have uptrend, downtrend, but also we have consolidation sideways, that we don't trade it always, but it is what you call accumulation. We don't take it, we don't trade it. Okay, you can trade it, but it is very, very risky. I don't want to teach you something that is very risky here, but if you want it, you can just write on the comment section if you're ready for that. I can prepare a special video for you. So because we are still looking at the market structure, let's look at what we call break in the market structure. Black in the market structure. Black in the market structure. Okay. So ladies and gentlemen, black of market structure, BMS, sometimes we call it BOS. Okay. BOS or BMS. This occurs when the price closes above or below a swing high or low. Generally, every trader should trade in the direction of higher time frame break of structure. So when the break of structure is in the higher time frame, it makes more sense than when you trade it in the very, very low time frame. Okay. So after break of structure, we always wait for retracement. Okay. For example, here you can see, let me show you by this chart, these lines here. So break of structure is when a high or a low is broken. In downtrend, break of structure is when a low is broken. Okay, as you can see, it is broken, then you have to wait for retracement. When it is broken, then we wait for retracement. Broken, then we wait for retracement. Broken, then wait for retracement. These are the OTEs from the Fibonacci retracement tool. You can see also in the chart here below, this is the downtrend. Okay, the market is coming down. This is break, this low when it's broken. Then we have a break of market structure, but here also down when it is broken. You have to know, break of market structure. When there is the break of market structure, it confirms that the trend is going in that way. Is going in that way. So it is the confirmation. Okay. Let me talk about let me talk about range high and range low. So after the break of market structure, there will always be the formation of a new consolidation. That is called range high or range low. Let me show you. So you just need to understand this. Always trade in the direction of lack of market of structure, because when there is lack of market structure, it is confirming the continuation of that trend, either uptrend or downtrend. Okay, but also remember that after every break of structure, wait for retracement to 50% or what we call OTE. These are golden Fibonacci levels. Let's take an example here. You can see this is range high. So we have, you can see here, I have told you what is range high. That is, okay. I have told you after the BMS, where there will always be the formation of a new consolidation that is called range high and range low. So here you can see, okay, this is range low and range high. Range low in uptrend is obtained at what we call a low point, a low structure. And then range high is always opened at high point. Okay, so in this point, what the market is trying to say, it is saying about what we call a range, because a range is the difference between a range low and range high here. You can see here. Okay, so this is what we call a range. And this is the distance between range low, this is the low point, and range high, which is the high point. After break of structure, remember, there must be a break of structure in between. And here also. So we can just say like a range is the distance between the beginning or the start of expansion movement to the end of expansion movement before retracement. And when the market will retrace, make sure it will retrace back to 50% or to the OTE for low risk buy or sell. In downtrend, you can see too, it is the distance between the beginning of what we call expansion to the end of that expansion before retracement. And this is what we call range high and range low. So when we are telling you that this is the ranging market, that means the market is not moving out of that range. It is just moving inside this block, this red block I have showed you here. When the market is moving inside here, that is what we call ranging market. Okay, this way, let me show you. Maybe you're not understanding. When the market is moving and you find it, let me show you. Let me show you. So when the market is moving this way and you find it, maybe it is just moving inside this block here. It is not going out, it's not doing what we call break of structure, it is just moving inside. That is what we call ranging market. Why? It is not shifting ranges. It have to shift it from one range to another, from one block to another. It must create another range high. Do you understand? Yes, this is nice. Okay. This is nice. So I'm just giving you full details on the market structure. This is the market structure. This is the first part. We're talking about the market structure. Okay, market structure. Any question, you can just ask it there below. Okay, so let's take an example of range high in the little market here. You can see the market is coming down, range high and range low here. This is the highest, this is the starting of expansion movement in downtrend, and this is the end of expansion. Therefore here in between there is a range, and between this range, between range high and range low is where you can get your entry points. Okay, in this distance is where also we draw our Fibonacci retracement tool. So we draw it always between range high and range low. Okay, you can see the market made what we call retracement to the OTE, and this is nice. But also we have another range here. You can see after just breaking this structure, that is new market to break structure. Then we have range high, we have range low. That is, we have shifted to another range, which shows that the market is still strong in downward movement. Okay, so let's talk about something we called SMS. So we were talking about lack of market structure, and now we are talking about failure swing, or we call it shift of market structure, because BMS shows the continuation of the trend. Shift of market structure is a sign that the market is about to return, to reverse. Okay, when there is an uptrend market and the price fails to break the last top or swing high and breaks the previous bottom, swing low, an SMS is considered to have occurred, and vice versa for the bearish movement. So let's talk about here. You can see we have this is failure swing, shift of market structure. The market was going upward, as you can see, it made a break of structure, it went to make a break of structure. But here you can see, let me show you with some colors here. Let me show you with some colors here. You can see here, we expected the market to come at this point, to break this point here. But what market did, it didn't break this one. Let me show you. It didn't break here. It failed to break this structure here, this high, and therefore it went lower here. This is the sign that we have a shift of market structure. Why? Because we expected to have higher high, but you can see now we have lower high, which shows that the market is about to change to downtrend, and therefore this is the sign. And when you have this kind of structure, you have to wait for the market to confirm that it is true that we had a lower high above. That is shift of market structure. We have to wait for the market to break below our lows. And when it breaks below low, that means it has formed what we call lower low. Therefore, because we have lower highs and we have lower lows, this is the confirmation of a downtrend, and we can start looking for the entry that is bearish entry. Okay, so shift of market structure is very important. This is one of the setup that I'm going to show you that you can use to enter and take some trades. Okay, make sure you subscribe if you're new to this channel, because we have a lot of things to share with you here free, because this is not priceless. You see, some people pay a lot of money just to learn about these techniques. A Lily chart, you can see the same kind of structure here. We could wait, and you can see we had a very clear order block here. I cannot show you order block right now. I'm just showing you market structures. In the next videos, you can see how we spot order blocks, because we don't want to confuse a lot of things. So we just need to wait for the market to retrace back, wait for this order block to be hit, and we can enter in that trade with bearish entry. So I will show you how do we draw order blocks and where to enter. But here you can see we had lower lows here, and we have lower highs here, which shows that the market has shifted from bullish to bearish trend. Okay, so that was the first chapter, and we were talking about market structures, basics market structure, and now let's come deeper and let's see some three types of trends: consolidation, uptrend, downtrend, as we have said. So I'm going very fast here because we have started already. So market structure in bullish conditions, how do we create it? In bullish condition, it is when you have higher highs and higher lows, as I have said. Okay, and this is very important. And in bullish trend, you can see we have blackout structures at the highs. So highs are broken, and down here to the retracement point is where we have what we call OTEs, okay, optimal entry points. Okay, so market structures in bullish conditions, you can see also here we have we've been creating expansion and retracement, as you can see, and at this point of OTE, it is the low risk buy entry. That means it is somewhere that you can enter with very, very low risky. So market structures, as you can see here, we have break of market structures, we have OTEs, and we have a reversal here with some shift of market structure. Okay, so let me end up here, and we talk deeper and deeper about the liquidity in the next video. So this is the first part. Make sure you make a follow-up, and we will go deeper in the next episode where we're going to talk about liquidity in a simple way. Have a nice day.